Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Monday, September the 22nd. The year is 2025. Let's talk trading. Weekly open and gap. And I just realized that should be in green. These videos are for educational purposes only. Your results may differ from mine. As always, have your risk management in place so you don't lose more than you're willing to lose on any one single trade or during any one trading session. So if we take a look at the weekly chart here, as we are entering the last full trading week of the month, even though next week we have a couple of trading days, we can see from the dashboard that all the open gaps have filled. The pound is 35 pips above the weekly open at the moment, and 21 off the high and 41 off the low. If we zoom out to the monthly, you can see we are just barely above the monthly open at like 1.3 pips and 231 off the high and 162 off the low. So right now the month is trying to make up its mind. Does it want to be green or red? And we're putting in the opening range for the week. As you can see, we are about 3 pips above the low of the opening range for the month. And we started out the day below the opening range for the month, but we're now back in it. For the year, 987 pips above the yearly open, 290 off that high, and 1,399 off the low. Okay, we are in the inside bar area for the weekly inside bar that happened 4 weeks ago. We're below the low of the daily inside bar that happened 6 days ago. And we are right at the 1.35 mark. For the day, the pound has 69 pips of range. The pound New Zealand is the new beast. It's leading with 142 pips. And it looks like the dollar yen is taking a break with only 64 pips of range. We're above the buy zone. Looks like we crossed that early in the London session or maybe to the end of the Asian session. It looks like the red rats might be ready to feast as we bumped against that 135, and now we're down to 134.97. Have to wait and see what happens. This looks like a return bar. This looks like the return bar of the day right here. Bambino flex indicators saying short, and we're right at the pivot. The pivot trading plan says to take a short here. So we'll have to see how that plays out. So we have taken out the daily pivot. We missed the pivot on Friday. So we have the weekly pivot so far is up at 135.52. And we have taken out the monthly pivot. And once again, we're showing a doji on the month. In and out of that lower wick zone from Friday's daily candle. Once again, 69 pip range. Nothing to really check on the smart ranges. You can see we're below indicator 2 on M30. Some nice trading ranges there on M30 over the past couple of hours. One thing I have noticed, you have to let me know if you're brokers too, that the spread on the pound has gone up to over a pip at times. Almost really makes it hard to trade. You really have to nail your entries when you've got spreads like that. And we still haven't pushed the year-to-date accumulated range. And as we saw in the charts, nothing much is going on today. So we can take a look at the daily here. We're between the wick zones. We've got a lower high and a lower low. So once again, a lower candle, but it would be what I would call a sucker bar, because even though a lower high, lower low, we've got a bullish candle here. So once again, we crossed down off that 135 psychological. Have to wait and see what happens here. Just put in a one ball. So if I was short, I see that one ball, I'm usually going to get out. Now, sometimes it can push to the next candle, but more often than not, it seems that what just happened would happen. It would reverse and I would give up most or some of the profit. So I just take that one ball and just play off of it. You know, one of the things in trading that we have to understand is the difference between an assumption and a fact. And since, it is trading and anything can happen, we have to keep that in mind, that anything we have, it's really an assumption. And so you have to be comfortable, trading based on assumptions. Because even though we have statistics, it's still an assumption that then when you enter the trade, it's going to go in the direction you think, you assume it's going to go in. And when it doesn't, that's when you start to manage risk. So you see here what happened was one ball just moved over. Some people would call that a repaint, but that's not what happened. So price came down and it made a one ball and it just moved over. Now, the thing about it is this big candle here, that's a return bar. So you see what happened. It returned to that open and actually beyond, and then it bounced. So that's a clue where, you had the price is going to get back to here. Then you had a one ball. It's like, oh, so price will probably reverse. And right there, you almost could have made a really quick 2 pips. And the other thing is, if you remember how fast this candle went down, price just dropped almost. when you see fast moves like that, a lot of times price will recover. Sometimes as quick, or sometimes it might take a candle or two to get there, or three or four. So you see right here, we had a three ball, 210 minutes ago right there. And you see what happened. Price hit that, got near that level, turned around and rocketed back up. And once again, these videos are for educational purposes only. Does that happen every time? No. But once again, you can make the assumption, okay, this support three ball, maybe it'll support again because we broke it once. We see this return bar here. Now we got almost a couple return bars again. Maybe price will come right back down. But this became a two ball, and two balls have a tendency to move on to three balls. So in that case, you'd want to stay in the trade. But this is just all chart reading, and once again, it's assumptions. But that's why you have to be a good risk manager, because once you put the trade on, that's what you're doing. You're managing the risk. And if you're wondering what these lines are, these are just the fib retrace lines. So the gray one is 50% retrace. The brown one is the 38. And what's the next one? 23. And then I also have a 10% here that I like to use, because usually if I'm going to be trading off of fibs, I'm going to want to enter in that 10% range. Right now we've got a flip-flop trigger right there. And so you see we came back to the open of that return bar. And I'm just eyeballing these return bars. It's like if they're bigger than most of the other bars on the chart, I'm considering those return bars. So like you see, there's this big bar here. That's a return bar. And it's mainly looking at the size of the candle bodies, not the entire range of the bar. So you might want to look at how you're trading and what assumptions you're making. And remember, they're assumptions. Saying what the daily open or the hourly open is, that's not an assumption. That's a fact. It's established. Any trader looking at the chart will agree with you. They know how to read a chart. But the rest of it, mainly assumptions, candle patterns, and all of that. Statistics, you're making assumptions. And that is why, fellow traders, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.